Trading is often perceived as a numbers game, dominated by charts, graphs, and technical analysis. While these tools are undeniably important, they represent only one side of the trading coin. The other, often overlooked side, is the psychological aspect of trading. Mastering your emotions is not just a supplementary skill, it is the bedrock upon which successful trading is built. Ignoring the psychological component of trading is akin to navigating a labyrinth blindfolded. You might stumble upon the exit by chance, but it's far more likely you'll lose your way. Think of the stock market as a vast, ever-changing ocean. The charts and graphs are like the maps and compasses, providing you with navigational tools. However, your emotions are like the wind in your sails. They can propel you forward with incredible force or, if left unchecked, toss you off course and into treacherous waters. To truly succeed in the markets, traders must develop a deep understanding of their own psychology, learning to manage their emotions effectively. This means confronting your fears, taming your greed, and developing the discipline to stick to a plan even when the market tempts you to deviate. The trading world is fraught with emotional landmines. Fear and greed, in particular, can sabotage even the most well-thought-out trading strategies. Fear, often triggered by the prospect of losses, can lead to paralysis, causing traders to miss out on potentially profitable opportunities. Greed, on the other hand, can fuel impulsive decisions and excessive risk-taking, leading to devastating losses. Imagine this. You've meticulously researched a stock and believe it's poised for a significant upswing. You enter a trade, and initially, everything goes according to plan. The stock begins to climb, and your confidence soars. This initial success, however, can quickly morph into excitement, then overconfidence, and finally, full-blown greed. You hold on too long, convinced the stock will continue its upward trajectory indefinitely. When the inevitable correction occurs, you're left reeling from the swift and unexpected loss. Frustration, another common emotional pitfall, can set in after a string of losses or when the market stubbornly refuses to cooperate with your analysis. This frustration can lead to revenge trading, a dangerous cycle in which you try to get even with the market, often throwing good money after bad. Recognizing these emotional pitfalls is the first step towards mitigating their impact on your trading decisions. Beyond recognizing raw emotions like fear and greed, it's crucial to understand the subtle ways in which our minds can sabotage our trading decisions through cognitive biases. Confirmation bias, for instance, is our tendency to seek out information that confirms our existing beliefs while ignoring evidence that contradicts them. A trader suffering from confirmation bias might cling to a losing trade, focusing only on news and analysis that supports their initial decision while dismissing any negative indicators. Loss aversion, another powerful bias, refers to our tendency to feel the pain of a loss more acutely than the pleasure of an equivalent gain. This can lead traders to hold on to losing positions for too long, hoping to avoid the emotional pain of realizing a loss, even when the rational decision would be to cut their losses and move on. Overtrading, driven by a desire for constant action and excitement, can also be detrimental to your trading success. This often stems from a fear of missing out, FOMO, on potential opportunities. However, just like a gambler who can't resist placing one more bet, the overtrader often ends up making impulsive and poorly considered trades. Section 4. Mastering your emotions. Strategies for trading success. Mastering your emotions and achieving consistent profitability in trading requires a multifaceted approach. First, create a trading plan. A well-defined trading plan acts as your roadmap, outlining your entry and exit points, risk management strategy, and the assets you'll focus on. This plan helps you make rational decisions based on predetermined criteria, rather than succumbing to emotional impulses. Second, implement risk management. Determine how much you're willing to risk on each trade before you enter the market. This prevents emotional decision-making when losses occur and helps protect your capital from catastrophic losses. Third, keep a trading journal. Regularly documenting your trades, including your thought process, emotional state, and the outcomes, provides invaluable insights into your trading behavior. This allows you to identify patterns, recognize emotional triggers, and refine your trading strategy over time. Fourth, practice mindfulness. Engage in mindfulness techniques like meditation and deep breathing exercises. These practices train your mind to become more aware of your emotions, allowing you to observe them without judgment and make more conscious decisions. Fifth, reduce trade size. Lowering your position size, especially when you're feeling emotionally volatile, can significantly reduce the impact of losses on your psyche. This allows you to stay calmer and make more rational decisions, even during periods of market turbulence. Sixth, take breaks. Stepping away from the market, especially after a string of losses or a particularly emotional trading session, can help you regain perspective. This prevents emotional exhaustion and allows you to return to trading with a fresh mindset. Lastly, seek support. Connecting with other traders or a qualified trading coach provides an outlet to share your experiences, gain valuable insights, and receive emotional support during challenging times. Section 5. Emotional mastery. The key to rational decisions and trading success. The path to trading success is not paved with complex algorithms or secret indicators. It is paved with self-awareness, emotional resilience, and the ability to make rational decisions in the face of uncertainty and risk. By mastering your emotions, you transform from a reactive trader, tossed about by the whims of the market, into a disciplined and focused individual, capable of navigating the complexities of trading with clarity and confidence. Remember, trading is not about being right or wrong on every trade. It's about making rational decisions based on your analysis and managing your risk effectively. By cultivating emotional intelligence and incorporating the strategies outlined above, you can transform your trading journey from one of emotional turmoil to one of consistent growth and profitability. Thank you for watching till the end. If you like the content, please like, share, and subscribe for more such meaningful content. Please don't forget to press the bell icon. Let's talk trade.